Hello everyone and welcome back to a new episode of Palantir Stock Analysis video. In the world of investment, Nasdaq has always been head and shoulders above all the other exchanges when it comes to the preference for retail traders who are looking for high growth opportunities. The potentials for disrupting technologies redefining entire sectors of the economy, along with the possibility of exponential growth in share price, has encouraged many titles to begin their adventure here instead of the other exchanges in order to become the titans of tomorrow, such as Apple, Amazon, Tesla, and Alphabet. Without those precedences, it's normal for traders to continue navigating the exciting and volatile waters of Nasdaq in order to identify a precise way to capitalize on the defining enterprises of tomorrow. Because after all, this is one of the birthplaces of the modern economy based on the connectivity, speed, and analysis using the tools and technologies of a new era. Amongst all the titles that may bring us wealth and prosperities lies Palantir, the data analytics firm based in Denver. Palantir has been an enigmatic company ever since it went public on the Nasdaq, with a reputation shrouded in controversies. As a data aggregator and analysis platform, it has one of the deepest relationships with the public sector entities for large contracts in healthcare, defense, and intelligence analysis. Its price action is directly linked with the company's own fundamentals and a risk appetite of the market. And with an increasing institutional participation in the company, there may be a lot more potentials to go. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. So, the macroeconomic landscape undergoing some noticeable shift in mind, we have to talk about the potential for for Palantir to go down, especially since for quite a while, Palantir has been trying to go and stay above the $20 level, but so far this has not been the case yet. But there are also other reasons why we have to talk about it. Because recently we have seen a huge red flag for Wall Street that came for the Main Street. So the last time when such a thing happened, it was because back in 06-07, the default rate for mortgages increased. So this time, it's the lackluster performance of the Black Friday and the upcoming holiday season. In this context, it's always useful to remind us that while the AI has been booming in the frequency it's mentioned in, conversations and happy hours and so on, and to some extent, it has increased the amount of wealth generated by some firms, mostly in the shape of, higher share price. We have to admit that in recent days there has been some change in the market mood, impacting not just Palantir, but other stocks like Nvidia, who just reported its financial results. This time the shift goes beyond just emotional sentiment, affecting the overall market dynamics. Because even in the optimistic articles, the market mood might be influenced, as the dip has been felt by most of the tech sector. Now, regarding Palantir, the correction post Q3 earnings has been anticipated since its continuous rally. The question was always about when the correction would occur. The trading volume went above, 100 million shares in recent peaks, and the market cap standing at around $42 billion. The bears have been eyeing for a potential retreat to the $18 range unless there's a key reversal to the high 20s, where some consolidation occurred. So when we look at Palantir's recent contract to win the United Kingdom's national health system, it initially appeared positive, but the market's reaction confirmed the buy the rumor, sell the news tendency and the profit-taking that ensued. The contract's value initially expected to be around $480 million, disappointed the market with around £330 million. So, this also over the course of 7 years. But despite this, diversifying in the healthcare sector remains as a strategic move for Palantir. Some view this correction negatively, like it is what it is, but it's crucial to acknowledge Palantir's impressive run, with around 46% increase since November 1st. A temporary pullback, especially with the support around $18, may contribute to the stock's overall health. Despite concerns about overvaluation, Palantir has thrived in the AI boom of 2023, with robust earnings and expanding its business operations as well. The broader market scenario does include the disappointing retail earnings impacting companies like Lowe's, Best Buy, American Eagle, and Kohl's. The declining consumer spending also cast a shadow on the upcoming holiday season expectations, potentially altering the expected Santa rally in December. So, for Nvidia's stellar earnings performance, it has definitely beat the Wall Street expectation, but it didn't shield itself from a market decline due to concerns about restrictions on chip exports. Looking ahead, uncertainty will still lurk around, especially with the Thanksgiving events and so on. Palantir's high price to earnings ratio is undeniable, but the correction is seen by some as a healthy adjustment. The recent contract win has likely been factored into the stock's value, contributing to the sell the news sentiment. In the midst of market's uncertainty, Nvidia's robust earning highlights the ongoing demand for more AI development and shares and stocks. The AI boom might persist into 2024 as long as the interest rates remain in check. So, I believe that the focus on the consumer growth coupled with achieving fourth quarter GAAP profitability will position Palantir in a positive spot. Although the ongoing correction is not unexpected, shall we say, it does present the opportunity for Palantir to become more attractive in the eyes of those who want to hold it eventually. Palantir's abilities to secure new deals, grow its customer base, and achieve profitability all bode very well for its long-term prospects. With that being said, here's a word about the technicals. The trading volume of Palantir is around 54 million shares compared to the average volume of 73 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded shows us how many shares are being bought and sold at any given time in the market and if there's enough liquidity to support the trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is going to be limited too. Now, when we look at the current volume against the average, there might be the possibility for trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is around $42 billion compared to an enterprise value of $15 billion. As we compare the current price to the historical fluctuations, the stock is 36% higher than the 1-month low, 44% higher than the 3-month low, and 238% higher than the 52 weeks low. In terms of the options, the implied volatility is around 51% compared to a historical volatility of 74%. Put-call ratio is around 40%. Many stocks have a higher put-option ratio than what they deserve because many positions are hedged by put options. The most recent volume of options traded is around 240,000 contracts versus the 30-day average of 370,000. In terms of open interest, the current one is around 2.9 million contracts versus the 30-day average of 2.9 million contracts. Regarding the shareholder structure, 40% of it is in the hands of institutional owners. The biggest ones include Vanguard, Renaissance, and BlackRock. Usually, it's always good to see some institutional participation when holding a stock long-term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it's going to deliver value in the long term, which is an important factor to consider for investors. I personally believe that a minimum threshold should be around 30% for institutional ownership. The current short interest is around 8% of the total float, and 55% of those transactions come out from the dark pools. Typically, if the short interest is around 15% of the total volume and a significant portion of the short volume comes out from the dark pools, this may suggest that a lot of institutions are preparing a short operation and that there would be potentials for a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Alright, so having said all this, what would be my own recommendation for Palantir? I think that as far as Palantir is concerned, considering the looming recession to come, we have to keep in mind that the current price action may not be the best, obviously, but that the macroeconomic circumstances may also give the market another major boost in terms of demand for riskier assets. This is why I believe that despite the potentials for lower rebounds and the potential bearishness in the markets, Palantir is a stock worth accumulating over time. The only question is how patient one should be with it. I believe that Palantir should be slowly bought over the next 2 years to ensure that the cost basis is as low as possible throughout the looming recession. But ultimately, it's actually worth our while to invest in such a company as long as AI and big data remain relevant themes for the investors. So I would recommend to commit overall 3 to 5% of your portfolio's capital in Palantir and to split the allocation in batches of 10 to 20% over time.